Good day, everyone. The second quarter of 2025 was ushered in with heightened levels of volatility across the markets as investors contended with tariff policy uncertainty and ongoing geopolitical tensions. Global equities and bonds were up in the second quarter. Equities were up sharply by 11.5%, and bonds by the lower but nonetheless still impressive 4.3%. That, despite tariff wars, threats to remove the Federal Reserve Chair Jerome Powell, and tensions in the Ukraine and the Middle East. So overall, a pretty remarkable outcome, all things considered. The dollar continued to depreciate over the period, and this stands out as one of the most significant themes of the first half of this year. This isn't the end of the dollar, we don't think, but rather acknowledging that the greenback had become outsized at around 70% of a typical global portfolio, which of course is a lot of risk to be taking in one country with one set of policymakers. Dollar weakness this year looks like basic, prudent diversification, i.e., not putting all of one's eggs in the same basket. Back home, quarter two of 2025 was a turbulent period for South Africa's economy. The country grappled with some domestic challenges of political strain within the governing coalition amid an uncertain global backdrop. However, SA equities continued their upward trajectory, up a significant 9.7% for the quarter and 24.6% over the past year. This reinforces the importance in your long-term wealth creation journey to remain disciplined and stay invested through short-term disruptions. While trade tensions and political noise may cause temporary volatility, they are often outweighed by enduring fundamentals. From a sector perspective, financials, industrials, and resources delivered solid returns of 8.7%, 11.8%, and 9.2% respectively. Local property recovered after delivering negative returns during the first quarter, so up at 10.8% for the quarter and an impressive 25.9% return over the past 12 months. Despite a slow start to the year, the JSE All Bond Index made considerable gains in quarter two, up 5.9%. The asset class benefited from relief on the survival of the SA coalition government and consistent positive inflation surprises. Apart from the 1 to 3 year maturity spectrum, all bonds delivered returns in excess of 5% for the quarter. The solid asset class returns contributed favorably to our multi-asset solutions, the MFP Focus model portfolios, and the Momentum Focus fund of funds. So let's now take a closer look at the performance of our Focus multi-asset solutions over the past quarter. It was a good quarter for the Momentum Focus fund of funds as well as the MFP Focus model portfolios. Our overnight position in local equity contributed positively to performance and also helped to offset the impact of the strengthening rand that detracted from performance of global asset classes. MFP Focus 3 was up 6.3%, while the Focus 5, 7, and 7 unconstrained model portfolios were up 7.2, 8.1, and 8.4%. The Momentum Focus fund of funds delivered returns of 6.1%, 7.2%, and 7.9% for the quarter for Focus 3, 5, and 7 respectively. The strong quarterly performance positively impacted on the solution's longer-term returns, with both 12-month returns outperforming their respective benchmarks and also surpassing their peer groups. The only exception being the Focus 7 fund of funds, which lagged slightly its CPI plus 5 benchmark, and the multi-asset high equity peer group. This was mainly driven by a lack of consistent strong returns from growth asset classes like equity and property. We have, however, closed the gap and now lag only marginally. The MFP Focus model portfolios continue to deliver on their objectives since their launch just over 4 years ago, with all the portfolios outperforming both their benchmarks and peer groups over the period. As we always mention, these funds have their suggested investment horizon. That said, staying invested contributes significantly to how successful one will be in reaching your investment objectives. Now let's take a closer look at our global managed solutions. All three global managed solutions delivered positive dollar returns during the quarter, ranging from 6.4% for cautious, 8.7% for managed, and 10.9% for growth. Performance was comfortably ahead of peers, and this again reinforces the view we've held that the majority of peers are anchored to US assets and the dollar than we are. Thus, our alternative worldview has therefore paid off in recent quarters. Asset allocation was neutral overall, while managers' selection was positive, with our UK equity manager Schroders outperforming by 12% after delivering returns of 21% in dollar terms. Over 12 months, the funds have returned solid returns of 12.3%, 15.3%, and 17.3% respectively in dollar terms. So where do we go from here? Shorter term, we think it's right to be cautious. We've had this big run up in the markets since their fall at the start of April, and we may well see some profit taking ahead of Trump's 1st of August deadline for trade talks. New barriers to trade aren't costless. Someone is going to have to bear the cost, whether it's exporters to the US or else US importers. Hence, we shouldn't be complacent. But at the same time, looking over the medium term, we also shouldn't lose sight of the fact that we're in this high return environment underpinned by US interest rates at 4.3%. From here, the extent to which interest rates can go up, hurting investors, is smaller than the extent to which they can come down, boosting investments, a more likely scenario. As a result, it's a good time to be invested. It's very hard to predict the next quarter. It could well be negative. However, we have a much higher conviction that portfolios can deliver positive returns from here longer term. Thank you.